have historically been one of the most affordable paths to home ownership. The median price for a condo or co-op was $380,000 compared with more than $446,000 for a single-family home as of June 2026. But buying a condo may be about to become significantly more difficult, even for buyers with good financial standing.
Hi, this is Michael Regan with Regan Team Home Loans, and welcome to this week's Real Estate Roundup for August 5th, 2026. And as you saw to start at the video, Fannie Mae and Freddie Mac announced earlier this year that they're making some major changes to condo loan evaluation. So essentially, as of August 3rd this year, they're really scrutinizing condos a lot more than they used to. One of the major changes that they eliminated was the limited review. The limited review procedure allowed us to only look at certain condo documents. And so a lot of condos that may have been on the edge or there may have had some issues one way or another could have gotten through under the old rules. But under the new rules, they're going to have a full condo review, which means really looking at the reserve study and their insurance. And so what we found is a lot of condos are underinsured and their reserves do not meet minimum lender requirements. And so that's going to be a big problem for many condo organizations. This all started because of the 2021 condo collapse in Florida, where the condo association didn't really maintain their building. And so there was a ton of deferred maintenance and it led to their collapse. Because of this, Fannie and Freddie have become much more strict on condos because they want to make sure if the buyer is able to buy it, that the condo association is in good shape and doing the job that they're supposed to do. And realize that certain condo associations that got approved earlier, even this year, may not qualify under the new revised guidelines. And now to two other things. So first, the ADP private jobs report came out today, and it showed that only 44,000 jobs were created in the month of July. Now, the market was anticipating 70,000, which isn't great, but it came in even less than that. So that was overall good news for mortgage rates, not so good news for our employment picture. And then into PCE, or Personal Consumption Expenditures. So this is the Fed's favorite measure of inflation. And the headline was down 1/10 month over month, and the core was only up 1/10. So that was really good, and it matched expectations. So the headline year over year is at 3.7%, and the core is at 3.3%. So it just showed that inflation cooled off, and that was mainly due to lower oil prices. Now let's look at what the market is doing today. Right now, the Fannie Mae 30-year fix is up 2 basis points, and you'll see the chart. Red is bad for rates, green is good. So with all this conflict in Iran, rates, you're seeing a lot of red and rates have gotten worse. Absolutely. Now, the last couple of days, because there may be some kind of agreement that oil can flow through and oil prices have come down, then the market has rebounded and we've seen better rates. That being said, we're not nearly as good as we were, several weeks ago, a month ago, but nonetheless, we have gone the other way where rates have gotten better the last couple of days. Obviously, we'll see if that holds true, but if the price of oil goes down, that's going to be great for inflation, and that's also going to be really great for mortgage rates. And that's it for this week's update. And don't forget, we specialize in reverse mortgages for seniors and cash flow loans for investors and self-employed business owners. Have a great week.